What if I told you the government actually wants you to pay less in taxes? Not through some loophole or shady workaround, but through legitimate investments that are baked right into the tax code. And I'm not talking about your basic retirement accounts or health savings plans. I'm talking about investment strategies with no contribution caps that can slash your tax bill by tens of thousands of dollars or more, depending on how much you're willing to put in. My name is Dre, and today I'm breaking down the exact investment categories that the wealthiest people in America use to legally minimize what they owe the IRS, and how everyday people can start using the same playbook. Here's the thing most people never realize. The tax code is not just a list of rules about what you owe. It's actually a roadmap showing you what the government is willing to pay for. Every major tax break exists because the government needs something done. They need entrepreneurs creating jobs. They need investors building housing. They need companies producing energy. And because they need these things so badly, they're willing to reward you financially for doing them. That reward comes in the form of tax deductions, tax credits, and in some cases, completely tax-free treatment on your returns. So the real strategy isn't about gaming the system. It's about aligning your investments with what the government is already incentivizing. When you do that, you keep more of your money, you build wealth faster, and you do it all within the rules. There are three major investment categories where these incentives are the most powerful, and I'm going to walk you through each one right now. The first category is business investment, and this includes starting even a small side business. Without exaggeration, owning a business is the single most tax-advantaged thing you can do in this country. It is one of the most reliable vehicles for building long-term wealth. It fuels the economy, and it creates employment. Think about basically any billionaire you can name. Odds are they built or own a business, and the government knows how critical small businesses are. Roughly half of all private sector jobs in the United States come from small businesses. The economy would collapse without them. So the government essentially subsidizes the act of investing in a business. When you put money into a business, whether you're launching one, buying into an existing one, or acquiring one outright, those dollars can qualify for tax deductions and even tax credits depending on how they're deployed. Consider how one of the largest corporations on the planet, Amazon, managed to pay zero in federal income tax for multiple consecutive years, even while generating enormous revenue. They did it by making massive strategic reinvestments. They poured capital into warehouses, data centers, delivery fleets, office space, and research and development across dozens of product lines. Every one of those investments triggered provisions in the tax code, things like accelerated depreciation and research and development credits, that offset their taxable income almost entirely. They didn't break any rules. They simply built their wealth in a way that the tax code rewards. Now, you obviously don't need to be Amazon to benefit from this. Even at the smallest scale, the government gives you a head start. When you're just exploring a new business idea, you can deduct up to $5,000 in costs related to researching and investigating that business. And if you actually form and organize it, you can deduct another $5,000 on top of that. This is called the Startup and Organizational Cost Deduction, and it applies even if your business never generates a single dollar of revenue, as long as it legitimately launched. Once your business is up and running, you also qualify for the Qualified Business Income Deduction, which gives you an additional 20% deduction on your business profits. That means dollar for dollar, business income is taxed more favorably than regular employment income. But the real power of business ownership is in the operating deductions. Most employees pay taxes on their gross earnings. Business owners pay taxes on what's left after subtracting every legitimate expense tied to running the operation. Marketing costs, software subscriptions, equipment purchases, professional services, contractor payments, all of it reduces your taxable income before the IRS takes its cut. And portions of expenses you're probably already paying for, things like your home, your vehicle, your travel, and your meals, can become partially deductible when they serve a genuine business purpose. Once you understand this framework, you start to see that your tax bill is not a fixed number. It's something you can actively manage by deciding how to allocate your business income across growth strategies, retirement contributions, and reinvestment, just like Amazon does at scale. The second major category is real estate investing. Real estate has long been considered one of the most powerful tax shelters available, and for good reason. When you own rental property, whether it's a single-family home or a commercial building, you're operating a real estate business, and the government offers real estate investors an extraordinary package of tax benefits. The biggest one is depreciation. Here's the fascinating part. Even though most real estate increases in value over time, the IRS lets you claim a depreciation deduction as though the property is losing value. It's a non-cash write-off, meaning you don't actually spend anything to claim it. And on top of depreciation, you can also deduct your mortgage interest, property taxes, insurance premiums, maintenance and repair costs, and property management fees. When you stack all of those deductions together, most rental property owners end up reporting little to no taxable income on their properties, even when the property is actually generating positive cash flow every single month. But it gets even more aggressive than that. Through a strategy called cost segregation, you can accelerate the depreciation timeline on specific components of your property and front-load enormous deductions into the very first year you own it. This is done through something called bonus depreciation combined with Section 179 expensing. To give you a sense of scale, on a property worth $1 million, a cost segregation study could generate over $200,000 in additional first-year deductions. For many investors, that single deduction is actually larger than the down payment they made to acquire the property in the first place. And here's something that surprises a lot of people. Even if you finance the entire purchase with debt, you can still claim the full depreciation. The IRS does not require you to use your own cash to qualify for these write-offs. The long-term wealth-building strategy with real estate is incredibly elegant. You buy property, build equity, borrow against that equity tax-free through refinancing, and when you eventually want to sell, you use a 1031 exchange to roll your gains into a new property and defer capital gains taxes indefinitely. Investors repeat this cycle for decades, steadily growing their portfolio and their net worth while paying minimal taxes along the way. It is one of the most time-tested wealth-building systems in existence. The third and final category is energy investing, specifically oil and gas. This is where the tax incentives become almost unbelievably generous. The entire global economy depends on energy. Oil and gas powers transportation, manufacturing, agriculture, and virtually every supply chain on the planet. When energy prices spike, the cost of nearly everything rises with them, which can trigger serious economic downturns. So the government has an enormous interest in maintaining strong domestic energy production. And to make sure that happens, they offer some of the most aggressive tax incentives available anywhere in the code. When you invest in a qualified company that conducts active drilling operations, up to 85% of your investment can be written off as a tax deduction in the very first year. Think about that for a moment. If you invest $100,000, you could receive an $85,000 paper loss on your K-1 tax form, which you can then use to offset income from other sources. This is made possible by a few specific provisions. The first is the intangible drilling cost deduction. In most industries, intangible costs like labor and fuel are not immediately deductible. But for drilling companies, the IRS makes a special exception and allows those costs to be expensed right away. The second is depreciation on tangible assets. Just like in real estate, drilling companies can take accelerated depreciation on their physical equipment, machinery, and even the wells themselves. And as an investor, your share of those deductions flows directly through to your personal tax return. But it doesn't stop at the deduction going in. There's also a benefit on the income coming out. Through something called the depletion allowance, the government only taxes you on 85% of the revenue your energy investment produces. The remaining 15% is completely excluded from taxation. So you're getting a massive write-off when you invest, and then reduced taxation on the returns that investment generates. No other asset class in the tax code offers that kind of double benefit. Now, a word of caution. Unless you plan to personally operate drilling equipment, you'll need to invest through a private company that manages these operations. And realistically, most of these deals are structured for accredited investors and carry meaningful risk. This is absolutely not something you should jump into without expert guidance. Working with a qualified CPA and a knowledgeable investment advisor is essential before committing any capital to this space. The bottom line is this: the tax code is not your enemy. It's actually a blueprint showing you exactly where the government wants private investment to flow. Business ownership, real estate, and energy production are the three biggest areas where those incentives are concentrated. When you align your investment strategy with what the code rewards, you stop overpaying in taxes and you start building wealth the way the wealthiest people in the country have been doing it for decades. If this video opened your eyes to what's possible, make sure you subscribe to this channel so you don't miss the next one. I'll see you there.